Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you, as always, for giving us your time and joining us on these videos. We hope you find them useful, and we continue, as we have always done in the past, to continue to deliver these to your inbox each and every week, save for the occasional holiday that falls on a Thursday like Thanksgiving. But otherwise, we plan to be right here with you, not as an obligation, but as an opportunity for you to catch some of our thoughts if you're so inclined to gather them. We typically, just if you're kind of new, we have a weekly investment allocation meeting that takes place on Mondays. Our advisor team, our portfolio team get together. We share our thoughts, kind of give the roadmap for where we have been going and what's been happening in the markets. We take a few of those key points and deliver them to you via this Market Carver. So we can keep you in tune with the major things that we are thinking. This week, those topics that we pulled out, there are three. We're going to talk about productivity growth, an important topic that I think is so key, and I'll unpack that. Then Andrew's going to talk about the mega cap weighting and the heights that we've gotten to there, and an updated look at the consumer confidence as it relates to their investing expectations. So let's jump right into productivity. That can sound like a pretty technical term, and it is, but I want to make it simple. So the economy is really going to be broken down into two things, or at least if we look at the growth of the economy, it happens two ways. Number one, it can happen from population growth. As we add people, as we do each and every year, that adds to the total economy, and that is usually around 1% growth. And that doesn't change very rapidly. You can have quick waves of immigration or speeding up or slowing down that may tilt that to 0.5% one way or the other. Of course, earlier, if you go back decades, it was closer to 2%. But as we age, we're right now around 1%. On top of that, how productive those workers are makes up the rest of how fast the economy is growing. And since the population growth is kind of set in stone from demographics, how productive they are really swings the needle in terms of how big and how fast the economy is moving. That productivity is going to be a function of several things. It's going to be a function of investment that has been taking place. Technology is so crucial. And it can be from other kind of factors that work themselves together. And one of the really key positive upsides that we have seen is a surge in productivity. This is, we're going to take a look at the right panel of this chart. It does move around a lot over time. Quarter to quarter, it is really volatile. So we like to look at a 5-year average. And we have moved up where we were kind of stuck at about a 1% productivity rate in the 2010s. That has moved up to about 2%. And so when you add that to the 1% population growth, that is what has allowed us to skirt by a recession that was widely expected 2022 or 2023. And has elevated us and helped us consistently outpacing expectations for economic growth. So that is key. And even better news, this is really before you see any true benefits from AI. So when we think about the things that have led to this productivity, we were certainly looking at some technology, but it had a lot to do with getting the right workers in the right seats. COVID shook things up. It could have been for the worse. That was the fears in the earliest part of the pandemic. But it all has worked out for the better. Immigration has actually played a key role in fostering stronger productivity growth as well. And this has implications for the national debt too, because see the difference between a 1% productivity growth rate, which is where we were for a long time, and 1.5% is tremendous. And that's what you see on the left panel, which is a projection of where the national debt as a percentage of GDP is going. When we look at the base case, if you see this in the Wall Street Journal, or the New York Times, whatever it is you're reading, you will often see that base case and the expectation for our debt to grow as a percentage over time. And it is. But if you change that total factor of productivity just by 0.5%, you could see that line there, the green line, keeping it much better contained. So hopefully this is a story that continues. And with AI, it does continue to improve. It won't curb all recessions. But over time could certainly be a big factor. So that was kind of a long-winded point there. So I will give you a reprieve here and toss you over to Andrew to take a look at some market trends.
All right, thank you, Adam. So as we come into the new year, we're going to circle back to a topic that we covered a lot last year in the market carver, if you've been a steady watcher of these videos, and that's looking at the heavy weighting of just a handful of stocks have been on the large S&P 500 index. They've kind of become the tails that wag the dog in that whatever their performance has been has really shaped where the overall market has gone. And so as we move into 2025, one of the topics that we had in our allocation meeting this week was looking at some of the themes that we think could maybe be a big impact or garner a lot of attention coming into the new year. And we think this is one that will continue to really drive markets either higher or lower. And it's looking at how the 10 largest stocks create or hold the largest, really large amount of weight in the overall market. Here's a chart going back to the 1980s, and you can see we've dwarfed really any other period in time to where such a few number of stocks account now at a new high of 38% over the overall market. What this means is if you have one of those stocks, Apple, Microsoft, Nvidia, any of those 10, if any of them hiccup or see any type of volatility, that's going to have an outsized impact on the overall market. So far over the last 2 years, as we've had back-to-back 20% years for the S&P 500, they've steadily rose along with some volatility on the way, but they steadily increased, meeting expectations to continue to grow, which is something they weren't doing at the time during the dot-com bubble when we had a lot of unprofitable companies. Another topic we've also discussed on the market carver, that right now these companies continue to be profitable, and it's something we continue to want to watch and monitor. And if they do start to, again, get a little bit sick, it seems like a lot of people are right now, then that could have a really negative impact on the overall market. Hasn't happened yet, but it continues to be something we think needs to be really focused on and heavily monitored in 2025. Now, the next point I want to turn to is going out of equities and now looking at consumer confidence. So every single month, there's a group called the Conference Board, and they do a massive study, a massive survey across the country, asking people their feelings on their own personal finances. What do they think about the economy? What do they think about inflation? And they also ask them, do you think the stock market will be higher or lower over the next 12 years? And that's the chart I want to show you today, and I'll tell you why. Because they're hitting really new all-time highs, essentially, in the amount of confidence that consumers have right now. So again, this chart, another one that goes back to the 1980s, and you can see really we never really breached 50%. There's always seems to be a little bit of pessimism of whether the stock market will do really well over the next 12 months. And you can see going back, if you look at kind of the middle, it says June 2008, when we were in the middle of the great financial crisis, that almost no one, barely even 20%, thought the market was going to do well over the next 12 months. And we continue to see that oscillate kind of between 45 and 30%. Now we fast forward to today on the far right-hand side of this chart, and you can see it's gone straight up. People are extremely confident. The reason for that can be several reasons. One, they have a little bit of recency bias because the market has done so well over the last 2 years. It could also be impacted by their own personal finances. They feel like they're doing fairly well, their job is secure, and so then they transfer that to how they think the economy and the stock market will also perform. And so this can be viewed as two different ways. It can be viewed as a positive that we're continuing to see economic growth and that consumers are very confident and that hopefully that will continue forward. And it also is a little bit skittish in the fact that when you have people that are too excited, they're too positive, that maybe we start to not meet those expectations and we see a little bit of mean reversion where we have too many people on one side of the teeter-totter, so to speak, and we need to get a little bit of a rebalance. We often see that on the downside where no one is confident at all, and those are great times to look for opportunities. We want to be a little bit leery when we start seeing everyone being very excited and very confident as we move into this new year. Confidence is very, very high, but maybe they have a right to be so. So we think this is really interesting that we are moving into a new year where the stock market has been very strong over the last two. People are very confident about that. The Fed is slowing down their rate cuts. There's going to be a lot of changes and things for us to be watching in 2025. We're excited as an allocation team. We think there's going to be a lot of good opportunities, and we're excited to do that work on your behalf. And we're excited to share that with you in these weekly videos.
Thank you, Andrew. As always, a great job there. And thank you to all of you again for giving us this time. As always, just a reminder, if we can be of service, whether we're currently working with you or not, we're always happy to see if we can be of service. Give us a call, 800-928-4001, or scan the QR code and do it electronically. Thanks so much, and have a great weekend.